Man, 2022 has been absolutely unrelenting for us stock market investors, and yesterday was an especially rough day. This guy on Reddit was asking what happened today, why did stocks fall? And the simple answer is more sellers than buyers. But yeah, it wasn't good. If we take a look at the heat map, Amazon, massive company, down 7% all in one day. We're getting to the point that people are saying you gotta stop investing in meme stocks like SPY and the QQQ. Just gonna go ahead and like that one. Okay, but of course the main reason for this is because we had new inflation data come out and it wasn't super pretty. So inflation rose 0.1% in August, even with a sharp decline or drop in gas prices. So CPI increased 0.1% in August. Excluding food and energy, the inflation gauge rose 0.6%, both of which are higher than expected. And this is the key point right here, expectations, not the physical number itself, so to speak. The main drivers here are an increase in food, shelter, and medical care services, which offset a sharp decline in gasoline prices. And let's go ahead and watch a little bit of this video clip on the topic.
Time now for the report. Rick Santelli, hopefully you've got the numbers for it.
Yes, the August numbers for the Consumer Price Index, headline number expected to be down is up 1/10 instead of down 1/10. If we strip out the all-important food and energy, and do understand, gas was down, 26% month over month. It's food that we have to pay attention to, up 0.6%, double the expectation. Now, the year-over-year numbers, expecting up 8%, up 8.3 on year-over-year. And if we strip out the all-important food and energy on a year-over-year perspective, it's also hotter than expected, up 6.3%. We're expecting up 5.9.
Now, the reason why the stock market reacted the way it did is because this altered the expectations. So now a 75 basis point rate increase in the next meeting is all but guaranteed. So the next meeting is in 7 days, 3 hours, 8 minutes, and 55 seconds. And this is pretty interesting data. So this is the target rate probabilities for the next meeting. So of course, the current target rate, it's a range. So it's 2.25 to 2.5%. And the market is currently giving a 70% probability that this will be the future rate hike, aka a 75 basis point increase. And there's now a 30% chance of a full 1 percentage point rate increase in the next meeting. And prior to this, devastating inflation report, it was kind of the opposite. There was a 30% chance of a 50 BP rate increase. So this completely changed the expectations, and that's why the pricing has to reflect that within the stock market. So the next obvious question is, where is inflation going? Is it going to be extreme and out of hand, or within a year's time, is it going to come down to more reasonable levels? And here we have semi-good news depending on how you want to interpret this, but the US inflation expectations dropped in August. Consumer expectations for US inflation over the coming years declined sharply in the latest survey by the Federal Reserve Bank of New York. Expectations for US inflation 3 years ahead fell to 2.8% in August from 3.2% the previous month and 3.6% in June, according to this survey. And to me, this is pretty massive news because inflation in many ways is a self-fulfilling prophecy. So if people expect inflation to, say, be more in the future, they're more likely to buy goods now, increasing inflation. And in case you don't believe me, here's an article on the topic. So it says right here that inflation expectations matter because prices end up reflecting in part what people expect them to be. It is a very scary time having inflation running this hot for this long. It's very intimidating. A lot of people are selling out of the market because of these uncertain times. But there is some data suggesting that this isn't going to be the thing that brings down the US economy, long term. It will survive. So these inflation expectations are good news, at least in my opinion. Some other good news is the strong consumer spending, which in part is driving up inflation. But during times of recession and just rough general times, you'd expect this number to come way down and people to hold on to their money like we saw back in 2020. But we're just not seeing that currently. And if we go to the forecast, it's not projected to take a nosedive. So this indicates that the consumer is still in a relatively strong position. And if we come and take a look at some of the unemployment data, it helps to back this up as well. But it's not all good news. Keep in mind that we are in a recession currently. So GDP decreased at an annual rate of 0.6% in the second quarter of 2022, following a decrease of 1.6% in the first quarter. So this is the reality of the broad economy right now. We're dealing with inflation, but if you look at some of the data, there are positive points. And with the stock market correcting in price 17.5% year to date, lots of metrics now put the market at a fairly valued metric. In fact, if we come over here and select the PE ratio of the market, it still is, kind of high, but it has come down to much more safe and realistic levels, broadly speaking, over time. But I will end the video by warning that even though the valuation has come down to a more realistic level because of the current situation of the economy, there still is a potential pain point for stock, and that is the future earnings of the actual companies. As of right now, it's mostly strong. Companies aren't seeing huge pullback in consumer demand. And that makes sense. Coming back to this data point on consumer spending, we're not seeing a huge drop off. But some companies like Morgan Stanley are warning that next year we could see an impact on earnings. And that, of course, could drive prices lower in the stock market. If you want my 2 cents on the market, I kind of agree with Meet Kevin in his latest video. And he essentially says that we're most likely going to bob around this low point in the market for the next year, maybe 2 years, until we get solid data that inflation is indeed going away. So I think the market's going to be rather flat at this low level with periods of high volatility, but I'm not expecting any major move to the upside or the downside, in my opinion. And that just makes me super grateful to be a dividend and income investor because I'm not solely reliant on the price to make a return. Dividends are way more reliable and they tend to hold up better than price action during sideways markets. That's gonna do it for the video. Before you guys go, leave a like, subscribe if you enjoyed the content, and I'll see you in the next one.